Welcome to Motley Fool Money. Thanks for being here. I'm your host, Chris Hill, and joining me in studio this week from Motley Fool Inside Value, Joe Magyer, from Motley Fool Income Investor, James Early, and from $1 Million Portfolio, Ron Gross. Gentlemen, good to see you as always.
Good to see you, Chris.
We have got dividends on the rise and one coffee stock on the decline. We've got one hot internet IPO and one retailer leaving investors cold. And as always, we've got a few stocks on our radar. But we begin with the biggest public company of all, and of course, that is Apple. Guys, shares crossed the $700 mark this week, but by Friday, the big story was what CNBC was calling the Maps fiasco. The operating
Mapplegate.
Mapplegate.
Nice.
Trademark that immediately. The operating system in the iPhone 5 has a new built-in map system from Apple that replaces Google Maps. And Joe, if the reports and what we're seeing on Twitter and on Facebook is to be believed, people are just not happy. So my question is, how bad is this for Apple?
Well, it's bad in the sense that it's going to shatter this image of Apple being the true, absolute champion of user experience. Clearly, from all the reports we've heard, Google Maps is a superior offering, so it's frustrating if you're a user. Like, I personally not upgraded on iOS, or upgraded to iOS 6 because I don't want to give up Google Maps. I'm pretty reliant on that. I do think that's going to hurt the image in a long-term sense, but they're still going to sell several dozen million of these phones.
At least
in
a
the
few
next
dozen,
year.
I would think.
So I don't think it's going to be a backbreaker.
James?
But plus, it's just petty, too. That's the thing that gets me. I mean, they're taking a page out of Microsoft's playbook, and that's what I don't like. I don't know if Steve Jobs would have done this, but I'm not sure he would have. I think what they're trying to do strategically is capture, I think according to the Wall Street Journal, location-based ads are now like 25% of all mobile ad spending and growing rapidly. So the market's there. I think this is just a gauche way to go about getting it.
Ron, what do you think? I mean, to James' point, this is clearly a shot across the bow of Google.
Yeah, well, clearly, and to that point, I saw a great Wall Street Journal blog that called this a strategy tax that Apple consumers were being forced to pay, which is an interesting way to put it. It's not a great move, but it's something that Apple thought was necessary for competitive reasons. I think it'll come out to be a mistake, and I think we'll see Google Maps back at some point.
Would you do this if you were heading Apple? Or are you not above that?
I'm not even smart enough to know where this is going down the road. But listen, I don't think this is a stumbling block in any way. As in the big picture for Apple, I don't think it has any impact on the stock in any major way. The phone is going to sell very well, and I do think they'll end up having to probably admit a mistake, and we'll see Google Maps back at some point.
Well, I think a more troubling thing is whether they keep up this pattern of putting their own interest ahead of the users. And I think the reason everyone loves Apple is because they've always been user first. But when they put Bing on the phone instead of Google, that's the next step.
Well, I mean, Joe, to Ron's point, I think that Apple has already admitted a mistake because they've already come out and said, this is going to get better. And so
that's as close as you'll get to an admission.
Exactly. So we've seen this once before with there was some iteration of the iPhone several iterations ago where they had the antenna problems. Steve Jobs, I believe, left his family vacation to come back to oversee the fix. So I'll just end on this, Joe. What is going to be the next step here? Are we going to see Apple backtrack and say, you know what, we're going to reinstall Google Maps or make it easy for people to get that? Or do you think that they're just going to push ahead as is?
I think Google Maps will pop up in the App Store sometime soon. But if I was Google, I'd wait a couple months and make Apple sweat it out, keep the bad press coming, and then you just swoop in like a savior with your sweet Maps offering. Everyone will be so happy.
Microsoft has increased its quarterly dividend by 15%. James Early, in real terms, we're talking about a dividend that's going from 20 cents a share to 23 cents a share. But still,
it's all relative. I mean, and now the yield is almost 3%, which is pushing it almost into my territory for income investor. Yeah. For a tech company, Chris, Microsoft has really been coming out of the dividend closet for the past couple of years, and that's been great. Although I will say technically this is a 15% increase, which is not as high as the 25% we saw last year. Things are slowing down, but the point being they're not squandering the cash, which is the most important thing.
Ron, what do you think?
Yeah, not surprised to see it slowing down 25 and then 23% the year before. I mean, the dividend's only been around since...
stats on the top of your
I think 2004 is when the dividend was initiated. So not surprising to see big gains right off the bat and then slowing down. But 15% is nothing to sneeze at, obviously. We like both Microsoft stock. We like it for appreciation potential, and now we like the dividend as well.
James, we also saw McDonald's this week increasing their dividend by 10%. Is this Are we going to be seeing even more of this as companies grow, as they get cash on the balance sheet? Is this the easiest and best way to make shareholders happy?
Right now it is. There are two factors, Chris. One is that companies do have cash and they're scared to hire en masse, so they have to do something with that
But
cash.
multilingual.
Just today. The second thing is that with bond rates really, really low, investors have shown a preference for yielding stocks. So companies want to get in on that action. McDonald's, the stock has done great. They're a little bit of a victim of their own success, but they're yielding over 3% now also. I think long term, that's another winner.
Joe, for a long time, Apple was the company that we talked about in terms of not paying a dividend. But when you look at your beloved Google with around $50 billion on the balance sheet, at what point does Google decide it's time for us to start paying a dividend?
We're in that territory where they're going to start getting some more heat. It's going to be tough for them to put that cash to work.
This week, Starbucks began selling a single cup machine called the Verismo on its website. Next month, it'll be available in stores like Williams, Sonoma, and Ron. I know what the market thinks of this move because this week, Starbucks shares up about 5%. And Green Mountain Coffee Roasters, with their Keurig machine, down about 15% this week. What do you think
How
of this?
about Green Mountain down 75% from its 52-week high? Yeah, this takes a bite out of them. I did look up. Verismo is the right pronunciation. And interestingly, it is an Italian opera, usually ending with someone's death.
Wow.
So that perhaps
Nothing
is...
says-
I love that every morning.
That is apropos to the Green Mountain situation. The K-Cup patents went off recently, within the last month. Starbucks is going to maintain the relationship with Green Mountain. They still will sell those K-Cups. But this is a shot across the bow in a big way. It adds to Green Mountain's problems that they're having with accounting issues, a lot of criticism there. It's a bit of a different target market. The Verismo is a high-pressure system for lattes and espressos, but it also makes brewed coffee like the Keurig does. So it's a little bit of a higher-end product. It is more expensive, but this is clearly competition.
Green Mountain has about 90% of the market share for the single cup machine. And Ron, I'm curious what you think about this thing that Howard Schultz, the CEO at Starbucks, said. He told the Wall Street Journal 75% of Starbucks customers don't own a single cup machine, and he expects to make converts of them with the Verismo. I don't know. That seems ambitious to me only because I drink a lot of coffee, but my kitchen is small, and I'm not going to buy one of these things just because I don't have the space for it.
I think that's a big number. That's an aggressive number. Interesting. I read another stat that said Starbucks already controls 25% of the K-Cup market, which is really interesting. But you're correct that the machines is where they want to go. They want that razor blade model to really kick in, and I think it will do well. I don't know if Schultz's prediction will really come to pass, but I think it's a nice area of growth for them.
You have a Keurig machine in your house.
I have a Keurig, and I like it, but I'm really not picky about really strong coffee. Dunkin' Donuts is fine for me. I don't have to go to Starbucks.
Maybe
so
around
it works for me.
Maybe around the holidays, something for your wife, a little.
Perhaps.
Coming up, did our man Steve Broido single-handedly push one stock to an all-time high this week? We will answer the question that all of Wall Street is asking. Stay right here. You're listening to Motley Fool Money. Welcome back to Motley Fool Money. Chris Hill here in studio with Joe Magyer, James Early, and Ron Gross. Guys, Nike said it plans to spend $8 billion buying back its stock. This will start in 2013 when Nike has completed its current $5 billion buyback plan. Joe, I'll start with you. Nike's market cap is around $44 billion. This seems like a lot of money to commit.
Yeah, it's a big bite. Yeah, I mean, Nike has a good problem on its hands. It makes more money than it can reinvest in the business. I'm not wild about this repurchase, though. It just seems like they're trying to put the money to work, but they're buying back stock at 20 times earnings. I think they could probably get a better price, be a little more patient. And, they'll put that money to work over a period of years, but really I'd rather just see them pay that back out as special dividends sporadically instead of just kind of forcibly repurchasing shares.
Buybacks should really be outlawed because 9 times out of 10 they happen at the worst possible time, don't they?
You heard it here first.
Outlawed?
Outlawed, Chris, outlawed.
All dividends all the time.
Regardless of the buyback program, Joe, when you look at Nike stock, is it fairly valued? Is it a little bit of a value opportunity?
Yeah, I'd say fairly. It's a wonderful business that I'd like to own for the long term at the right price, but I think 20% cheaper would be more attractive.
Real estate listing service Trulia went public this week, and Ron, I think this must be the opposite of Facebook because on the opening day, shares went up 41%.
Street loves it. Investors are loving it. I mean, Zillow, which is the closest competitor, very similar, has done quite well, too. I think it went public 20 and now sits at 45. They've already done a secondary offering.
Yep.
Business models are very similar. There's obviously a need out here for people wanting information about real estate. They're really targeting the realtors who would want to advertise and gain customers through the online world. My wife's a realtor. I know many realtors. They're not necessarily in love with this product.
Darn you, price transparency.
There's a lot of criticisms about the estimates they come up with, whether it's the Zestimate for Zillow or Trulia's estimate. I checked out my house on both of them. They were within $35,000 of each other, but they were significantly off in general.
On a $10 million house, it's pretty close, too.
It does provide a lot of great specialized information, and investors certainly are interested in it. Trulia is not profitable yet. But they're growing gangbusters, so people are hoping they grow into that valuation.
Grow into that 12 times sales valuation.
Right, exactly. It's only $645 million market cap.
It's tiny.
But for a company not profitable, hey,
Now, you mentioned you checked it out in terms of the estimate for your house. I actually typed my address into Trulia, and what I didn't focus on the estimate of the value of my home. I focused on the information about my home, which, similar to Zillow a year ago, not correct.
Right. Now, this is interesting. So Zillow allows you to...
I don't have that many bathrooms in my home.
Zillow allows you to go on and change it or and make it more up to date. And Zillow is now suing Trulia because Trulia does the same thing, and Zillow is citing a patent infringement. So it'll be interesting to see how that
Patenting
works.
the idea of correcting information?
Correct. Right. Exactly.
I thought they were suing them.
Who would have thought of that?
Whiteout is next.
Yeah.
I thought they were suing them because Trulia was also using the word Zestimate.
Yeah.
Guys, the hits just keep on coming for JCPenney. CEO Ron Johnson told analysts that JCPenney's shops within its stores are doing 20% higher sales than the rest of the stores, but that it's, quote, way too early to draw conclusions. James, I think investors have drawn their own conclusions. Shares of JCPenney down about 10% this week.
Chris, I'll draw my own conclusion, too. I mean, this store is done for. I don't care about the store within a store. I mean, there's $888 million in cash, but the last 12 months, the company had a net income of negative $540 million. So this is a bathtub with a pretty big hole in it. They're trying in desperation to change their name
with free haircuts.
I guess all bathtubs have holes in them. That's just a weird analogy, right? But with the stopper removed. Okay, think of it that way. They're trying to go by JCP now. That it reminds me 10, 12 years ago, Kmart changed their name to be the Big K. That's how they wanted to be called. And how well did that work for them? I mean, the only way they can really survive is if they just totally destroy the concept and do something new, which they're not going to do because they're going to try to maintain the old customer base, which isn't much.
The company plans to transform its stores into a collection of 100 specialty boutiques.
Wow.
By 2015, is Ron Johnson going to be the CEO in 2015?
No.
Because there won't be a company in 2050. I wouldn't go that far. This is just a disaster of a store, though, in my view.
The problem with retailers is a tough business. And you got to say to yourself, if this company or this store went out of business tomorrow, would people be freaking out? Where's my JCPenney? And I think the answer is no, because there's so many other substitutes. And so poor execution, really not needed, not differentiated, spells trouble.
And yet, if they are doing well with these shops within the stores, is that to the extent that there is a Hail Mary pass that Ron Johnson can throw, is it simply just doubling down on that and speeding up that process? Is that the path forward?
Well, there's no doubt, Chris, as negative as I am, there are no doubt monetizable assets within JCPenney. There's some brand. There's just the fact that people come to this facility. And so maybe there's something they can hive off there. It just won't be the core concept, is my view.
Shares of Darden Restaurants hit an all-time high on Friday after reporting better-than-expected quarterly profits. Darden is the parent company of Olive Garden, Red Lobster, Longhorn Steakhouse, and others. And Joe, Olive Garden is getting the credit here because for the first time in the last 6 quarters, there was a rise in comps at Olive Garden. What do you think when you look at this stock?
Well, I'm not a big fan of restaurant concepts. It's a very similar dynamic to retail. It's just a bad business over the long term, but they've done very well in each of these niches. You think steak, you think Italian, you think seafood, and each one of their flagship restaurants there is broad enough that people know it, and you can go there and get a broad selection of food, and you're comfortable with it. So I can see why they've been doing well.
You can always drop us an email. radio@fool.com is the way to email us. We got an email from Dave Beatty in Wildwood, Missouri. Last week, guys, we had talked about McDonald's putting calories on the menu, and Dave emailed to say that he thinks that McDonald's gets a little bit of a bad rap there. And he writes, there are a lot of other places that probably have a lot more calories in the average meal purchased at their respective restaurants. From personal experience, I've put on the most weight when I start eating at Olive Garden and Red Lobster more often. And then he, in parentheses, he
How
writes,
could that be?
sorry, Darden. So long as I'm being relatively active, I can work off my more frequent than they should be meals at McDonald's, no problem.
So what you're saying, a fried chicken breast smothered in cheese over a large bowl of pasta has a lot of calories?
You mean endless fried shrimp is a bad idea?
Did I mention the bread basket?
Unbelievable.
Matt Greer, our producer, and I, we actually, when we got the email, we were checking out the menus at Olive Garden and the calorie content, and I think the number one calorie item at McDonald's has 1,150. That's the big breakfast with hotcakes and biscuits. And Olive Garden.
Most important meal of the day, Chris.
Absolutely. Biscuits? Yes, it is. Biscuits are a part of any wholesome meal. Olive Garden just has a whole bunch of items that are 1,400 calories and above. And at this point, we'll bring in our man, Steve Broido, because among other things, Steve is the biggest fan of Olive Garden that I think
Number one fan.
Steve, first, did you help in the last quarter, in the last 3 months? Were you part of same-store sales for Olive Garden going up?
Unfortunately, I was not. I have not eaten there recently. We have a small child who is not yet a fan of the OG. He will be as he ages.
Are you doing Thanksgiving there?
No, we are. I wish we were.
Do you have any kind of Buyers Club type card from there?
I don't. I should get a T-shirt made or something.
What is your favorite go-to dish there?
Chicken parm all the time.
That's
The endless salad, it just doesn't get much better than that.
Do you have a rebuttal for Dave Beatty in Wildwood, Missouri, who's basically saying, look, don't pick on McDonald's, look at Olive Garden?
I can't really rebut it. There is it's terrible for you. I mean, I'm not going to lie. It's just terrible for you. But it's delicious. And my favorite part, I always tell my wife, is the chairs with the wheels on them. It just makes getting around the Olive Garden that much more enjoyable.
Wait a minute. It's been a long time since I've been to an Olive Garden.
They've remodeled recently, and they removed the wheels, but for years that was the.
So where do you wheel around? Like you wheel the bathroom? You wheel
around to see your neighbors, talk to your friends. It's just terrific. It's
family style.
Absolutely.
I was going to say, because whenever I see the commercials on TV, that's the big, to Joe's point, the family style. That's the big thing they're pushing. It's come have a big family meal. It's all about, when you come to Olive Garden, your family, and now what I'm hearing from Steve is
we offer wheelchairs.
We offered wheelchairs because what says safety more than that? Yeah. And two, we don't go there because we have a child. What do they not have chairs for your boy?
They do have chairs for him, but I think he's a little too young to fully appreciate the menu.
The endless breadsticks.
All right, Joe Magyer, Ron Gross, James Early. We will see you a little bit later in the show. As always, people on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against, so don't buy or sell stocks based solely on what you hear. I'm Chris Hill. Joining me in studio once again, Joe Magyer, James Early, and Ron Gross. Guys, time for the stocks on our radar. We'll bring in our man Steve Broido from the other side of the glass, assuming he hasn't dashed off to Olive Garden. And I should point out that also joining Steve on the other side of the glass this week, longtime listener Hans Schubert and his dad Lee celebrating his 50th birthday. So
happy birthday.
We will spare Lee and we will spare all of our listeners by not actually singing happy birthday. But we'll bring Steve in with a question for each one of you. Ron Gross, you are up first. What's your stock this week?
I am going to circle back around to Starbucks, SBUX. The stock is off from its highs, mostly out of economic concerns and some rising commodity costs. But they're diversifying their revenue streams, whether it's via or Evolution Juices, the new Verismo. I think they've got plenty of international growth ahead of them. Stock doesn't look cheap on the face of it, so I need to dig in there because 15 times cash flow doesn't scream cheap to me, but I think they've got some nice growth ahead of them.
You know what would help is if you bought your wife one of those new Verismo
may help.
3 or 4 of them.
Ron, does this ever leave your radar?
No. Well, it's a great company, and when the stock pulls back, that's when I get interested again.
Steve, question for Ron?
What does the future look like for tea for Starbucks? I've heard that tea is a big opportunity for them.
I think tea is definitely, obviously, a big trend, as are cake pops, by the way. You might want to try those. But I think
what is it?
Cake pops. Have you seen those cakes on a stick?
Never heard of that.
Oh yeah, they're big at Starbucks now. I think tea definitely has a place going forward. There's standalone retail stores that do tea, but I think Starbucks definitely that's one of the areas they'll go in.
James, your stock this week?
Chris, I'm going for an 11% yield in a company called Newcastle Investment Corporation. The ticker is NCT. This is a REIT, a real estate investment trust. Typically buys various mortgage or real estate securities and mortgage debt. It's actually a 5-star stock in our Motley Fool Caps database. It is up 73% year to date, which helps me a lot because I bought this for my wife's IRA a couple of years ago and watched it go almost down to nothing, and now it's actually back on the upswing.
Congratulations. Steve, question for James?
Could you just explain to me how REITs work?
That's a long question, Steve.
We don't have that kind of time.
They typically hold real estate or real estate-related securities. They don't pay income taxes. That means your dividend is fully taxable, so you want to hold it in an IRA or some kind of tax-deferred account. Typically, they're given the structure to encourage investment in our U.S. Real estate infrastructure, just in general.
No breadsticks.
No, there's no breadsticks. No chicken Alfredo when you're talking REITs. Joe Magyer, your stock this week?
International Speedway. They own and promote some of the biggest races and tracks in NASCAR. So Daytona, Talladega, Kansas Motor Speedway. NASCAR attendance and TV ratings have plummeted over the last 5 years, but there's a saving grace here, which is that there's been a big boom in what networks are willing to pay for TV rights for live sports events. And there's a big renegotiation coming up with NASCAR this coming year. I think International Speedway is going to do very well coming off that.
Steve?
What's the biggest future opportunity for them? Is it merchandising? Is it, it sounds like the TV rights are a huge deal. Is it sales at the events?
The real big dollar ticket is the TV rights. It's very high margin.
And the ticker symbol?
ISCA.
Are you a NASCAR fan, Joe?
No, not really.
Okay.
Steve, you heard 3 stocks. You got one you're particularly curious about?
I don't know. That dividend sounds very, very appealing. So I may have to go with Mr. Newcastle over there.
All right. Joe Magyer, James Early, Ron Gross. Guys, thanks for being here.
Thank you.
Thank you, Chris.
Thanks to our guests this week, Tim Hansen and Andy Cross. As I mentioned, Worldwide Invest Better Day, September 25th. Circle your calendars, and there's more information to be found at investbetterday.com. Check it out, investbetterday.com. That is it for this edition of Motley Fool Money. Our engineer is Steve Broido. Our producer is Matt Greer. I'm Chris Hill. Thanks for listening. We'll see you next week.